Neil. Awesome, guys. Thank you very much for joining this evening. Thanks, Curtis. G'day, Laura. G'day, Josh.
Everyone should all be well rested after a pleasant long weekend.
Very, very good. All right. Well, look, thank you again for joining us tonight. We're really, really pumped. I guess a lot of our clients are, either going through a build, have bought something, have completed, they've got tenants in there now. And what we want to do is ensure that you as investors have got the absolute maximum, kind of tax benefits that you're entitled to. Now, full disclosure, we're not, tax accountants, so don't hold us to it. But what we want to do is ensure that you've got the right information so that you can give your accountant all the correct data so that you can get the best outcome tax-wise.
Yeah, and particularly I think for a lot of our clients, it's the first time going through a tax sum with an investment property. So it's just good to take notes, have a bit of a checklist so that, as Josh said, when you go to your accountant, you can hand everything over and you're maximising all your benefits.
Amazing. So look, we're going to kick off, guys, and I think there's a couple of people that are going to be joining. Obviously, we like to do these things typically a little bit later in the evening after everyone's gotten home, at least got a quick bite to eat and things like put the kids to bed. So yeah, people will be, I guess, jumping in a little bit later on. So, all right. So, just quickly, as an investor, you've got, some pretty significant tax benefits that you do have access to, there's a lot of tax deductions kind of flowing around the economy. So in the 2019 to 2020 financial year, there were $38 billion worth of deductions. So again, really, really good to see that obviously if you structure yourself correctly, there's some pretty significant tax savings on offer.
And keeping in mind as well that during that period, most of those properties would have had a cash flow positive scenario. So with interest rates at record lows during that time, a lot of properties wouldn't actually have been benefiting from negative gearing. If anything, they're probably in a positive cash flow position.
So look, if you're a landlord, obviously there are some significant ways you can reduce your taxable income. And so we're going to go through that. And obviously nationwide, you've got, around 1.8 million investors. And so number one, you want to make sure that you're maximizing those benefits, but obviously you want to do so in a legal manner. So, everything that we're going to discuss here this evening is really about legal means to reduce your tax. And again, full disclaimer, we're not accountants, so you will need to discuss these in more detail with your accountant. There you go. So like I mentioned previously, it's a general reminder, obviously this is a general advice. And then, obviously if you do have an accountant, we're more than happy to liaise with them with regards to particular information they need to finalise your tax return as well. So we keep all, a pretty decent amount of records on what our clients do. So we'll be more than happy to help.
So I guess how can you make the most of your investment property, reducing your taxable income? So I guess a lot of first-time investors are not quite sure what they can claim, how it all sort of works, what sort of receipts they need to be keeping. So we'll go through the next slide, but it's a bit of a checklist. And I always sort of tell people that it makes it a lot easier when you get to the end of tax year and when you go speak to your accountant, set yourself up a little Excel spreadsheet. And just document each of the expenses that you pay throughout the year, because a lot of people get busy, a lot of people lose, the receipts that they're paid for, etc. They change email accounts, they change banks, whatever it may be. So it's easier just to keep that ongoing record. And I guarantee that when you go see your accountant, he'll thank you for it, as opposed to coming to him with a shoebox full of receipts saying best of luck, try and help me out. So yeah, definitely set up a bit of a spreadsheet, and we'll go through it next. But different things that we can actually claim throughout the year that you may forget by the time tax time rolls around.
Alrighty. So now the thing is, everything associated with your investment property to a certain extent is tax deductible. Okay, so what you've got to remember is that, the advertising costs. So when you go to advertise your property, quite often what you'll find is your real estate agent will put it on domain.com.au, realestate.com.au. They, if they do charge you an advertising fee for that, they will provide you an invoice at the end of financial year, or on your end of month statement. That itself is tax deductible, whether that's online, where it's brochures, signage. If they charge you for any of that, that is 100% tax deductible. Okay. Also, the property management fees. So obviously what happens is the property manager collects the rent on your behalf and puts it into your bank account every 2 to 4 weeks, depending on your arrangement with them. They charge you a fee. That involves generally a letting fee, which is when they sign up the property or re-sign the property. And then as well as that, I guess an additional monthly fee, which is a percentage of the rent. That is 100% tax deductible. Now, at the end of the financial year, generally what the property manager does is they give you an end of year summary, and that's a very detailed breakdown of their fees and all the expenses that they've paid for you out of your rent throughout the year. So they make it nice and easy to give to your accountant.
Yeah, good note there as well. So you'll get an end of year statement. Wait for that to come through. I've had a couple of clients, proactive as they are, jump the gun, try and start to calculate it all themselves. And once they've gone through all the hard work, they actually get an itemized statement at the end of the year. So wait for that to come through, and that'll give you a nice little breakdown of exactly how much rent's been collected, exactly what's been spent, what's been collected by the property manager, and what their fees were.
Yeah, exactly right. Repairs and maintenance. So any general repairs that you have to make to your property. So, let's say, for example, you had a leaky tap, or, there was a, door handle that needed to be replaced. That there is all 100% tax deductible. We'll go through it in a bit more detail a little bit later, but there is a difference between a capital improvement to a property and a repair. So we'll discuss that a little bit later, but general repairs and maintenance are 100% tax deductible because that's the cost of maintaining your investment.
Obviously gardening and upkeep. So if you're helping your tenants out and you've got a gardener that comes in and mows the lawns, some properties obviously come with pools and things like that. So all that sort of maintenance and I guess just general repair is all tax deductible as well.
Obviously your home and contents insurance, so your building insurance, your landlord insurance, that's all tax deductible. So make sure you do keep a record of that. Because it is quite, especially building insurance anyway, and landlord, but it's quite an expensive insurance that you pay to protect your asset. So you want to make sure you keep receipts for that being, tax deductible as well.
And just on the home and contents insurance as well, if you've got to make any claims against your tenants, they might be skipping rent, or you might have to go to tribunal. Generally, your property manager will itemize those fees, but if you do have costs associated with that, that's all tax deductible as well. And then pest control. So typically what you'll find is that most properties will need pest control once every sort of year. That is tax deductible, and you'll also have in most states the maintenance of smoke alarms as well. So you'll have an ongoing check that generally your property manager will organise, but that is also tax deductible.
Alrighty, just a small note to mention as well is these are all tax deductible during the periods in which your home or investment was rented or available for lease. What that means is that while in some instances we've got clients that are actually building properties, these fees or all these expenses are not tax deductible while you're building the property. As soon as the property is available for rent, essentially you can then moving forward claim all these expenses.
Yeah, it's all prorated, so to speak.
Alrighty. Now, a very, very big cost associated with holding an investment property is interest that you pay to the bank. So investors can claim the interest charge on the loan for the investment property and any bank fees for servicing the loan. Okay, so for example, if you've got a $500,000 mortgage for a rental property with an interest is charged at 5% per annum and paid monthly over a 30-year period, over a 12-month period, you pay $15,000 in interest for the loan. That's a $15,000 tax deduction to offset the cost of your investment property. So essentially what you want to ensure is that you're keeping very, very good records of how much interest you're actually paying. Just remember that if you were paying interest over the space of a year, however, your property was only available for lease for 6 months of that year, you're only able to claim 6 months worth of deductions.
Yeah, so the interest during construction of the property is not tax deductible. As soon as it's ready to obviously advertise, it then becomes tax deductible. And I guess the big one as well is it's only the interest component that is tax deductible. So if you are on a principal and interest loan, you cannot claim the principal component. It is purely the interest.
Yeah, so again, what will generally happen is, depending on your lending institution, they'll send you an end of year statement associated with that loan, and you'll be able to then go to your accountant and go, look, guys, here's my end of financial year statement with my real estate agent. Here's my end of financial year statement with my lender. And so you can marry up and work out, how much it costs to hold the property for a year and how much income you receive from that property as well. So it's very, very important.
And this is an important one as well, with obviously chitter chatter, and we've now seen 2 interest rate rises. But as the interest rates go up, you'll find that your interest is obviously increasing as well. So you'll find that your tax deductions will more than likely be a little bit larger as we move forward over the next year or so, particularly as interest rates start to increase or continue to increase.
So this is something to note as an investor, because a lot of people kind of get really, really worried when interest rates increase. Look, there's 2 things that you should take into consideration. Number one, both Nathan and I are of the belief that unfortunately tenants are going to be bearing the brunt of these interest rate rises, which is really, really unfortunate, because there is a real shortage of rental accommodation.
Yeah, well, it's put people in a really awful predicament where, as a landlord or as an owner, you've got the ability as an investor to up your rent. If you're an owner occupier, you've obviously got to cover those costs. But as a landlord or investor, you can actually pass those on to your tenant. So you're increasing their rent. And unfortunately, at the moment, because we're in such a housing shortage across the country, most tenants don't have the luxury of saying no thanks and moving on. So they've got to fight to keep their place, and obviously wear the brunt of any sort of interest rate rises that are going to continue to occur.
So even though interest rates are increasing, a lot of landlords will be in a position to increase their rent further. The other thing is as your interest rate, the interest that you pay increases, so too does the tax deductibility that you receive. So it is a bit of an interesting scenario where if an investor is well poised in the market, as most of our clients are, you'll find that even though interest rates are rising, you'll be able to achieve higher rents, but also as well as that increased tax deductibility. So the net effect won't be as bad as many of our clients think.
Correct. So the next thing that we can obviously claim, and we would have received, or a fair few of us would have received these through the construction period. So we can pro-rata them, obviously, once we start advertising for tenants. But it's your council rates, and that's obviously to do with the collection of garbage, maintenance of roads and things like that. And it's your water rates as well. So the water rates themselves, obviously paid by us as owners of the property. The water usage, so for most of you, you'd have tenants in your properties. The water usage is paid by the tenant themselves. So if they go and have long showers, water the garden, etc., that's on them. But your council rates, water rates, all tax deductible. And you can only claim these, as we said, during the period that the property was rented. So a lot of you have been through a build process. Unfortunately, during that period, the water rates and the water usage actually falls back on us as the owners. So for an example, if your investment property was only rented for 180 days of the year, then you can only claim your rates for that period, which would mean you're looking at about a 49.3% vacancy, 49.3% claim, which is 180 over the 365 days of the total amount. All right. Now, typically what you find is, particularly with water rates and council rates, they'll either come out quarterly or yearly. So it would be just working out when you've obviously started advertising your property and then dividing that to pro-rata it throughout the year.
Yeah. Sorry, guys, I've just got an email from our marketing team that there might be a couple of people trying to get into the seminar. Just give us 2 seconds. I want to make sure we've got everyone in. I'm just going to pause this for 1 tick. Apologies, guys. I just want to make sure that we've got everyone, because there's a fair few people trying to jump in, but they've not been able to do so. Give me 1 tick. Thank you.
Security at the front door.
G'day guys. Sorry, bit of a technical glitch, but I think we're back. So yeah, it does seem to be a bit of an issue. What we're going to do is we're going to have to obviously, and we're just going to record this and then shoot it off to our clients who might not be able to get in. So the joys of modern technology.
So 2 years and still haven't been able to work it out.
Yeah, we've been running these webinars quite regularly now, probably once a month, once every 2 months, and we generally nail them technology-wise most of the time, but sometimes things go wrong. So, but yeah, all good. We'll just keep chugging along, guys. All right. So land tax and strata fees. So essentially, what happens in Australia, guys, if you own over a specific threshold or an amount of land in a specific state, you're up for land tax. So it differs from state to state. So you can own a piece of real estate in every single country, every single state, and not pay any land tax as long as you're below the threshold. But if you own 5 pieces of real estate all in the same state, then you basically are liable for land tax. Now, with regards to land tax, it is 100% tax deductible as long as you've got the property rented out and obviously up for lease. And then the thing to remember as well is that the levies are different from state to state. So you want to ensure that your land tax is not a flat rate as a percentage of basically the value of real estate you own. You want to make sure that you're putting in the right amounts and you're able to claim that appropriately as well, because it is an annual tax that you have to pay and it's a state-based levy.
And that will come off your land rates as well that you receive. So the deductions themselves are not on the actual full property price. It's only on the land component, which is obviously the dutiable value.
Yes. So as well as that, guys, so if you've got a strata title property, so many of our clients have also purchased townhouses and apartments. What you can actually claim is the strata fees in their entirety. Okay. Now, also as well as that, you can claim a small proportion of land tax if you're over the land tax threshold and you are getting charged land tax. It's going to be a smaller apportionment for strata titled apartments and townhouses because you've got a smaller land allotment, but you can absolutely claim that as land tax as well, okay, as a deduction. Now, something that we haven't touched on also is that in many instances, and you'll need to really dig into the legislation, but when you're actually purchasing a property and you've got lender's mortgage insurance, that's also tax deductible, but it needs to be spread over a 5-year period. So you can depreciate your lender's mortgage insurance at 20% over a 5-year period. So on top of the interest that you pay, guys, you should also be letting your accountant know, hey, you should be able to, your, borrowing costs include the mortgage insurance, and you should be able to depreciate that over a 5-year period.
Yeah. And then the only other thing to touch on the strata side of things, you'll obviously have your strata fees if you own a strata title property, any sort of special levies as well that do pop up, also tax deductible. So if you have any sort of issues around, water leaks in the garages, things like that, where you are hit with a special levy, also keep a hold of those.
Alrighty. And I guess this is the exciting one for our investors. This is the big one. It's depreciation, guys. So essentially what depreciation is compensation for wear and tear on an income producing asset. That's the simplest way to put it. All businesses depreciate their assets, and having an investment property is a bit like running a business. What happens is your property as it generally does, suffers from general wear and tear, and you can claim compensation for that. What that means is that the bricks and mortar can be depreciated at 2.5% of its value over a 40-year period. And then you've got your fixtures and fittings, so your door handles, window frames, ovens, tiles. They can be depreciated at 20% of the value over 5 years.
Yeah, and the important thing to note, and investors were getting a little bit cheeky probably about 3 years ago now, well, probably a little longer, 4 years, 2018. And what a lot of investors were doing is with the internal fixture and fittings over the 5-year period, that's where you get a bulk of the depreciation benefits. So back in 2018, a lot of investors were actually buying properties that were, say, a year old or 6 months old, and basically collecting the grandfathering of those fixtures and fittings. The government obviously offers the depreciation benefits to try and stimulate the, production of new houses. So they clamped down on that in 2018, and to get the fixtures and fittings and that full 20% over the first 5 years, the property has to be brand new and not yet lived in. So again, a huge advantage if you do go through the build process or you buy something that is a brand new apartment not yet lived in, as opposed to something that's already established and has been sort of sitting around for a few years.
So it is, I guess, a benefit, buying brand new. Not only do you get something that's going to give you less issues by way of repairs and maintenance, but importantly as well,
huge tax breaks,
which is ideally what we want. We want to claw back as much as we can from the ATO. Alrighty, so depreciation is a huge part of what you can claim as an investor. And the first step to claiming depreciation is obviously arranging a depreciation schedule. Okay. Nathan, what does it look like?
Whole pile of numbers.
Yeah.
So don't ask me how it all works. I've got a rough idea, but essentially what you'll do is, and most of you should have already done it. If you haven't, smack your hand. But we do send out an email coming into the completion of construction for all properties. And you've got a link there to get a depreciation schedule. Now, that's a one-off schedule that will last you for the life of the property. So the 40 years that you're going to be able to claim that depreciation. What you'll have is a quantity surveyor will typically, if it's a brand new property, only need the contract of sale and the inclusions. And then they can basically strip all the numbers out and the equations from that. If it's an existing property, which some of you may have existing properties, they may need to go out to the property itself and actually inspect, see what sort of inclusions you've got in there, because again, each item is depreciated at a different value. And then again, if it's an apartment or a strata townhouse, they may need to go out as well just to look at what the common property and the common areas look like. So again, if you're in an apartment or a townhouse, you can still claim the depreciation benefits on things like pools, gyms, cinema rooms, things like that. So
what you'll do, guys, is if you look, I'm just going to get my mouse, and you look at this section here, you've got plant and equipment. Plant and equipment refers to fixtures and fittings. In year one, you've got $6,136 worth of deductions, and you have not run a physical loss there. So that's $6,000 of deductions just on your fixtures and fittings. Now, your division 43 is your bricks and mortar. Okay, so that's 2.5% of the value of the bricks and mortar for 40 years. So you can see 6,290 is what you can claim there. Cumulatively, you've got $12,426 of deductions that you're claiming year one. That is huge. So imagine you're on the highest marginal tax bracket, and again, let's say, or second highest, you're paying 40 cents in the dollar. Essentially what that means is you're going to receive approximately, again, round figures here, 40% of 12,426 by way of a tax refund to you. Obviously pending, cash flow on how much rent you've received and your interest, but there's another 12,426 of deductions that physically does not cost our clients a cent. Okay, but you're able to write it off in your tax return. And you can see the subsequent year, you've got 11,700, 10,200, 9,200. It is a really, really great initiative to help you reduce your taxable income, but importantly as well, it doesn't cost anything. So again, it just helps you reduce your taxable income, which means that you get more by way of a tax deduction at the end of the year, and hopefully get a significant tax refund.
Yeah, and one of the quickest and most effective tax reduction strategies floating around at the moment.
And then obviously, as well as that, if you haven't got your depreciation schedule yet, reach out to us. We'll send you the link, and you'll be able to get a depreciation schedule organized through our recommended provider, which is Depreciator. Basically, we give them a lot of business, and so they do a bit of a discount for our clients. And obviously you're able to get that. You do not need to order one every year. It's just a one-off fee, and it lasts for the full life of the property essentially.
And just making note as well with Depreciator, they've obviously been around for 20, 30 odd plus years. Very good at what they do and know what they're claiming. You do get a couple of cowboys in the industry that do put up cheaper quantity survey reports, but typically not worth the paper they're written on and littered with errors. So yeah, definitely if you are getting a depreciation report, make sure you're going with someone reputable.
Yeah, absolutely.
So I guess the big question for most people is how much do I actually get back? It all sounds pretty good, but what are the actual numbers? So it really all depends on what your building cost was. Building a brand new house through asset-based properties are returning about 10 to 14,000 in depreciation in just the first full year. So as Josh alluded to in the previous slide, that comes off your taxable income. And over the first 5 years, you're looking at a roughly $50,000 in deductions for depreciation of your taxable income. So again, equating to roughly four to 5,000 for a lot of our clients each year in tax returns. You're looking at anywhere from sort of 20 to 25 grand in tax returns and cash flow back into the property over that first 5-year period.
And now, obviously, the situation with rising rates has changed things a little bit, but essentially what you've got to remember is that if you as an investor are cash flow positive, but still getting a tax refund because of depreciation, essentially what we're doing is we're converting ATO dollars into income into your pocket, but what you're actually doing is holding assets for the long term that are going to grow in value as well. So in an ideal world, what we want to see is our clients holding multiple assets that are growing in value and then obviously not costing them anything to hold. Now, this might change as interest rates start to increase, but what we want to ensure is that the cost to hold those investments is far less than the growth. And that's a strategy that we've helped many, hundreds of clients, employ as well.
Yep. So negative gearing and positive gearing, probably a topic that gets thrown around a fair bit. Negative gearing hasn't been in the papers since Labor tried to talk about it last election or 2 elections ago and got shut down. But essentially with gearing is borrowing money to invest. Okay, so if we're borrowing money from the bank to invest and it's returning us a positive return, then it's positive gearing. If it's actually costing us money on the money that we've borrowed, then it's a negative gearing. So if your investment property's rental income is less than the expenses, so that's your interest, your water rates, council rates, property management things and everything else in between, you can deduct this as a loss from your taxable income. So in the extreme, cases, you'd have high income earners that, they might be sitting on $1 million, $2 million paychecks. Their strategy to reduce that taxable income at the highest level would be to buy something that's maybe a growth asset in the eastern suburbs, where it might be costing them, hundreds of thousands of dollars a year to hold, but they can write that all off as a tax loss and then obviously claim the negative gearing benefits at the highest marginal tax bracket. On the flip side of things, these benefits are normally advantageous to individuals with high incomes. So for most of our clients, we steer to a strategy where it really is
cash flow neutral,
or if not cash flow positive, so that when we do get the depreciation benefits, we're in a situation where most of our properties will be, positively geared, if not neutrally geared.
Yeah, look, negative gearing is not a strategy that we love to employ. We much prefer our clients be cash flow neutral. If not positively geared after your tax benefits. The reason being is that we, are of the belief that, if you're running a $200 a week loss in order to hold an asset, essentially what you're doing is you're throwing $10,400 a year at a property, to hold a property. Okay, so we need to be really bloody confident that you're going to achieve exponential growth on that asset because you're throwing money at something that's costing you something, costing you a fair bit to hold. So for us, negative gearing hasn't always been the best strategy that we like to employ, even in an environment where rates are starting to rise, which is very good because it's a requirement to calm down the growth in the economy. But essentially, you'll still find that most of our clients will be cash flow neutral. So, negative gearing is not something we heavily, kind of promote because we don't think it's the best strategy for people. Alrighty, so something else. So we've talked a little bit about the tax deduction side of things, but you also need to think about what happens if you sell your investment, okay? Because, in an environment where things are, people are, chopping and changing and having to sell and buy assets, you need to take those things into consideration. So if you make a capital gain on the sale of your property, unfortunately, the government want you to pay some tax on it. So I can't remember the exact year, but it was around 1986 ish, capital gains tax came into play. And so what that means is that if you make a profit on selling an asset like a investment property, the government unfortunately wants their share of that profit as well. So if you bought and sold your property within a 12-month period, basically 100% of the gain is assessable. That means that, let's say, for example, you made $120,000 of profit. You as an investor would then go, okay, well, I'm making $80,000 a year. I'm making $80,000 a year. I've made $120,000 profit. So therefore, your taxable income for the year will be $200,000. So what you made throughout the year and the gain. So you'll be paying a fair bit. Now, if you hold that property for more than, a year, basically what happens is the first 50% of the gain is given to you as a discount. So you're not paying tax on the first 50% of the gain. The subsequent 50% gets incorporated into your taxable income for the year. So if you made, $180,000 of growth on that property over a 2-year period, the first $90,000 goes into your pockets without an issue. The next $90,000 gets taxed based on your marginal tax bracket. So you want to ensure that you're not selling too many assets in the same financial year, because essentially what will happen is you will load up your tax bill quite significantly. It's much smarter to sell them throughout multiple financial years to ensure that you're not paying more tax than you need to, because it could be quite a significant burden as well.
Yep, 100%.
Alrighty. A few things you might not know that have recently changed. And yeah, very, very interesting. So to claim most tax deductions, your property has to be tenanted. So I know that Anil had a question earlier with regards to council rates and water rates. Absolutely. Unfortunately, until your property is not tenanted, but basically put up for lease. So day one, it gets put up for lease. Essentially, you can then claim everything apportioned moving forward. So if you're going through a build process, if you're in the process of, getting it ready because you're renovating your property, whatever it may be, and you're paying interest, unfortunately, you cannot claim anything. So interest, council rates, water rates, landlord insurance, building insurance, whatever it is, you cannot claim it until it becomes available for lease day one. And Nathan's favorite one.
The second one that I get asked is obviously travel costs. And this used to be able to be claimed. So if you owned a property in Queensland, and a fair few people did, you could actually claim part of the travel costs of visiting the property off your taxable income. Obviously, a lot of people were obviously popping up, having a quick 5-minute look at their property, and then
enjoying a nice
holiday on the cost of the taxpayer. So this all got changed around because obviously everyone was doing it. Again, a lot of my clients asked me whether this is still applicable. And I always have the same answer. If it was, I would have investment properties in Spain and Greece, which I do not, because I'd be on the first plane going and checking them out every second weekend. So you can no longer claim these costs in terms of inspecting the property themselves. Now, there are a couple of exclusions, again, not applicable for mum and dad investors, but if you have entities and the landlords are actually carrying out property investing as a business, then they can essentially write part of those costs off.
All right. Now, the next thing is capital improvements. So capital improvements are different to repairs and maintenance. So I did mention a little bit earlier, there is a difference between the two. These are essentially permanent repairs or structural alterations to the existing property for the purpose of increasing the overall value of the property. So let's say, for example, I've got a property and 2 of the kitchen doors, the cupboards fell off. A repair would be getting them, kind of fixed, replaced, and putting 2 panels back on. If I decided to rip out the entire kitchen because I didn't like the color, I didn't like the way it looked, I didn't like the layout, the functionality, whatever it was, that becomes a capital improvement. So you can, obviously claim a $200 cupboard repair on your annual tax return. You can't claim a $20,000 brand new kitchen on your tax return as a deduction that financial year. Unfortunately, that is what's called a capital improvement. When you go to sell the property in the future, whenever that may be, essentially what will happen is that will come off your, it'll be calculated as part of the cost of the property when you're doing your capital gains calculation. So where previously, for example, you might have had, hey, I bought my property for 500 and then I sold it for, 600, there's 100 grand profit. What it'll be is, hey, I bought my property for 500, spent $20,000 on the kitchen, and so my gain is only 80,000 now. It's not the full 100,000. So again, with regards to a capital improvement, your accountant needs to be able to differentiate what they are, and they are the ones that will determine whether what you're doing is a capital improvement or a repair. Okay.
And hence why, as I said earlier, keep a Excel spreadsheet of any sort of improvements, repairs, things like that you do make, because again, if you're selling your property 5-10 years later, you generally forget about a lot of these improvements.
Oh, absolutely.
So it does help you out, and I've been in that position where, as opposed to scrambling through emails and trying to track down statements, it's a lot easier if it's all in a spreadsheet. Just to tap on Josh's previous comments as well, a $20,000 kitchen, probably extreme, but also make note that if it's replacing, say, a $300 dishwasher with an upgraded, $1,500 dishwasher, the product that's being swapped out or repaired has to be a like for like. So again, it's even down to the fact of, basically changing your appliances and paying for a premium product when you initially had, a dud $300 dishwasher that's gone under.
So yeah, the ATO would generally like to see things being like for like.
Yeah.
Alrighty. So look, obviously not being accountants or financial advisors, what you need to do is we suggest our clients take active steps nice and early to prepare for your tax return. The quicker you can get it to the accountant, the quicker they can lodge your tax return, and the quicker you can potentially get your refund back. Okay, so now again, we're not aware of every single person's circumstances. So if you run to the tax man or the accountant and they tell you you owe tax, you can't come after us. Our intention is obviously to take as much money back from the ATO as possible. A very, very important thing to remember is once your property, if you are going through a build, when the property is complete, you definitely need to get a quantity surveyor, who we recommend is Depreciator, out to get that report. You need to ensure that that report is given to your accountants. And so if you have lodged your tax returns last year and didn't have a depreciation report, you need to actually get a depreciation report and actually amend your last year's tax returns. We did have a couple of clients miss that email that we sent them requesting that they purchase a depreciation report. So, a bit of extra paperwork, to relodge old tax returns, but it was worthwhile in the end.
Yeah.
And then as well as that, if you haven't got that report, reach out to Holly at Asset Base, who's going to be able to point you in the right direction with regards to getting that sorted. It is really, really important to make sure that you're really well organized when you are leading into tax time, because essentially it is a really, really critical part of you continuing to build out your portfolio, making sure you're getting the maximum amount of tax deductions.
Yeah, 100%. And if you've got any questions or anything that doesn't quite make sense, we're always here as well. So shoot any questions through to Holly. We'll be able to sit down and just give you our point of view on each of the questions.
Awesome. Look, what we might do, guys, is we'll just jump into the chat. And if you guys have got any questions, obviously we'll do our best to answer them, from our own personal experiences.
Property specialist perspective, not a tax accountant perspective.
Exactly right. So, all right. And Neil, I think we answered this one a little bit earlier, but understand that water rates are taxable during the periods. How are council rates and water rates? Absolutely. Well, unfortunately, that is the case. Only your council and water rates are only able to be deducted from the day in which the properties are made available for lease. Okay. Shirosh Jacob, negative gearing, positive cash flow. Will that impact the next investment property from the bank's perspective? Absolutely. If the best way to describe it is if you had a property and it was costing you $200 a week to hold that property, when you go to borrow money for the next property, the bank will be hesitant to let you borrow more money because they're going, okay, well, Josh, you're having to chip in $200 a week. We're not really comfortable lending you more money at the moment because you're covering this shortfall. However, if you've got a neutrally to positively geared property, they'll go, okay, Josh, well, you can see that this property is actually paying you $50 a week. And so therefore we feel much more comfortable and, letting you borrow some more money. So absolutely getting a good yield and positive cash flow will help you borrow more money in the future. Those that are very heavily negatively geared do find it more difficult to borrow money.
Yeah, 100%. We've got Anil there as well. So is stamp duty tax deductible? So funnily enough, no, it's not, apart from the ACT.
Yep.
So every state and territory bar the ACT, non-tax deductible. So it's what we consider a capital cost once again. So it can be claimed off your capital gains when you sell the property, but ACT is the only territory that you can claim it as a tax deduction. Which obviously, go figure, where all the politicians live, they get the best benefits.
Yeah, so ACT is an interesting one. So some of our clients have purchased in the ACT over the last couple of months. And yes, something to note is obviously if you do settle and pay, your stamp duty in this financial year, you will be able to claim that as a tax deduction. So the only state or territory in Australia that you can do that.
Yep.
With regards to investment templates, look, we haven't got one specifically that we use, but we do have a bit of an Excel spreadsheet that both Nathan and I kind of use personally. I'm more than happy to share that with you, Curtis. So I'll get that over to you in the next day or so.
As an investor, I understand taking our building insurance, but in what scenario would I take out the contents insurance? So as an investor, you've got both landlord and building insurance. So the building insurance obviously covers the property against, again, what you're insured for, but fire, in case the property is destroyed, floods or whatever it is, if you've got flood cover. And then you've got landlord insurance, which protects you as an investor in case your tenants skip on rent, damage to the property. Contents insurance is taken out either when you're living in the property yourself as an owner occupier, or you're a tenant and you've moved into the property.
Or alternatively, you're in Airbnb.
Airbnb, correct, yeah. And you're renting your property out as a furnished apartment or a furnished house. That's when you take out your contents insurance. But if you're renting your investment property out, like most of our clients are, where it's vacant possession and your tenants are just moving straight in, then there's no contents insurance. It's just the building and the landlord.
So yeah, obviously, they're all very, very important. It just depends on what style of what strategy you're looking to implement. For us, and going on a bit of a tangent here, with Airbnb income and holiday income, what you'll typically find is that income is quite sporadic. So you might get some really big months around, let's say December, January, but the rest of the year is really, really quiet. So what you'll find is that there's a cash flow mismatch. So you're getting all this income, but your repayments occur monthly. So it's a management of that. So most of our clients who we've helped for the better part of half a decade now, are just renting out their properties in a more, sort of standardized scenario on a week-to-week basis. And that way they collect the rent every single month and the repayment comes out every month as well.
Yeah. If we reach the threshold for land tax, will we be notified, or is it our responsibility to track the cumulative value of the land?
No, so the land tax, the tax office will, so the New South Wales government or Queensland government or Victorian government will let you know once you're over the threshold. So what you've got to remember is that every state has got different thresholds, and it's not the value of your property. So let's say, for example, and you purchased a $700,000 house and land package in Queensland. What you'll find is that the threshold for land tax, for example, might be $600,000. Okay, so you might think you're over the threshold, but what you've got there is the value of the land and the building that you're thinking about. So it's only the land value, not the building value, that gets attributed to the threshold. And as well as that, your principal place of residence is exempt from the threshold as well.
Keeping in mind as well that the key word is tax. So if you owe tax, the government is more than likely going to be chasing you up.
Absolutely. Absolutely. They'll let you know.
They'll let you know. Next question here, from tax perspective and as an investment portfolio purposes, is it better to hold negatively geared property or cash flow positive property? Again, it comes down to your individual strategy. As we said, for some people that are on really, really high incomes, they chase slightly more negatively geared properties because they're looking for tax deductions. And they may be looking at assets that are, in prestige locations, closer to CBD locations, where their rental yields might be a lot lower, but the opportunity for growth is a lot higher. On the flip side of things, a lot of people will chase cash flow positive properties because they may be phasing into retirement. They may be in a situation where, they're a single person with 2 kids or whatever it may be, or they're on a lower income, so they're chasing that cash flow. So their strategy is really on a day-to-day basis, and they're happy to sort of sacrifice that longer-term growth, I guess. We typically find that most of our clients, to build a successful portfolio, need a mixture of both. So again, most people can't save for a second deposit. So we really want that capital growth in the property so we can recycle it for the second investment property's deposit. But we also want to make sure that we've got the cash flow there, because when we go to borrow money from the banks, we want to be able to continually increase our serviceability. For a lot of people, obviously, your incomes, reading the papers, no one's incomes have been increasing, but most people's incomes stay fairly stagnant and increase gradually. It's that extra rental income or that cash flow positive property that's going to continue to be able to bump you up in that servicing side of things.
Yeah, absolutely. So look, Sherosh just shot through obviously a link. Look, I'm more than happy to chat with you, Sherosh, after and go through that. I haven't got time, obviously, to read the whole article. What I want to make people very acutely aware of is that the media are there to sell stories and papers, guys. So there was talks of, the property market crashing 30, 40, 50% after COVID. Both Nathan and I heavily invested in the middle of COVID. What we have to realize is that, fundamentally, we need to cut through a little bit of the noise and decide what's best for you as an individual investor. So I'll take the time to read through this article, Sherosh, and I'll also put through my email address, which is pretty straightforward, just joshua@assetbase.com.au. And I'll be more than happy to kind of run you through, my thoughts on what's in the article. But yeah, look, we've done plenty of videos as well over the years where basically the media love to manipulate and kind of look at, certain topics and things that they think will get them, clicks and likes. Our job as property advisors is to actually go, hey, that's not true. That is true. What's good for clients? What's not good for clients? We've been doing this for the better part of 13 years in the industry and 5 years at AssetBase. And I can tell you wholeheartedly, we've been able to help clients through every different property market. And we've experienced quite a fair few over the last 13 years.
I think the big thing as well, no one's going to read a newspaper article that says property market, gradually increasing. Yeah, pretty boring story to read.
Absolutely.
Where if you can say property prices increasing at 20, 30%, you're going to get a click. You say it's going to drop by 20 to 30%, you're going to get a click. So again, they're fighting for new space. They're fighting for clicks. So you typically find as well that a lot of the information in these articles, particularly the investment magazines and things like that, are quite skewed depending on what sort of story or representation they want to sort of present.
Absolutely. But I'm more than happy to read it, Sherosh, and I'll send you our thoughts on sort of what's in there as well. So
cool.
All righty. Thank you, guys. So look, thank you for taking the time to join us this evening. I hope you guys found it helpful. And look, certainly if you do have any questions or queries, feel free to reach out and let us know. We're more than happy to help. And have a great evening.
Cheers, guys.
Thank you. Take care.